Welcome back to our intermediate financial accounting class. Over the last few segments, we've been talking about cash flows, and we've had a lot of fun doing journal entries and T accounts and examining transactions. We've talked about the conceptual basis behind the statement of cash flows. We've talked about the simplified versus the actual method for doing cash flows, and we've been doing a great example that's been pulling all sorts of stuff together that we've learned in our intermediate accounting course. So it's been a great review along with learning how to do cash flows. When we finished last time, we had just wrapped up the part of step 5, going through the balance sheet, that walked us all the way through our asset accounts. Now that we've walked through our special transactions, we've walked through the income statement, we've finished looking at the assets for anything maybe we've missed or any working capital accounts that will help us reconcile accruals to cash flows in our operations section, it's time to move on to our current liabilities. And that's where we're going to pick up now with accounts payable. Now, accounts payable for some companies can mean a lot of things. In many 10Ks, all the short-term payables will be lumped together in one accounts payable line. And when that happens, you have to dig a little deeper to split out what part of this set of payables is cost of goods sold and what portion is for salaries and what portion is for interest and what portion is for taxes. It takes some digging. Since we're still learning, we haven't done that yet. You notice here that I've got salaries payable, interest payable, income taxes payable. I've got them all separate. So I don't need to worry about what part of accounts payable is cost of goods sold versus other things. At this point, we're using accounts payable just for the purchase of inventory. And that's what we're going to use this for, is to help us differentiate between what we show as cost of goods sold, $3,490,000, and what we actually paid for that inventory. We did part of that adjustment using the change in inventory account. And we showed that of the almost $3.5 million, some of it we bought last period. So it doesn't affect our change in cash. The other thing we want to look at with accounts payable is, did we buy things on credit? And if so, did we not have to pay for them this year and we'll pay for them next year? Or did we maybe miss some payments or didn't make some payments last year that we now have to pay for in year 6? And that's what this adjustment is going to do. It's going to help convert cost of goods sold into cash paid for inventory, not based on what was on our shelves, but what we were doing with our suppliers. And in this case, we went from $600,000 and now we're down to $347,000. So what did we probably do? Well, we probably sent a check to all of our suppliers and paid off a lot of what we owed them. So even though cost of goods sold was only $3.5 million, and a lot of that was inventory that we'd purchased in previous periods, we also paid a bunch of cash based on what we purchased on account back in year 5. And that's going to up the cash paid for inventory. And the way we're going to do this is we're going to take the 347 minus the 650. That way, as accounts payable goes down, cash goes down. There's our negative adjustment, $303,000. I'm going to mark that in green for step 5. And I'm going to put the change in accounts payable right here. And there we go, 303,000. And I'll mark it in green. Next is our salaries payable. And again, we can use this salaries payable to help us reconcile between our salaries and wages expense and what we actually paid our employees. So let's see, we went from 21,000 to 18,000, meaning at the end of last year, we owed them 21,000. If that drops to 18,000, we must have paid off some of what we owed them. I accrued salaries and wages expense of $632,000, but I paid a little bit more than that. Paid them part of what I owed them from last year. Again, I'm going to mark this in green and this in green. Interest payable, same basic process that we're looking at. In this case, we've accrued a lot of interest that we haven't paid. So we've showed it as interest expense, but we haven't sent a check yet. So our cash actually paid in interest is a lot lower than what we're showing as interest expense. Next, we've got income tax payable. And again, same basic process applies. We owe the government even more money than we did in the past. So of this income tax expense, there's a bunch of it we haven't sent a check in for yet. So our cash paid for taxes will be less than the income tax expense because we're holding back not going to send the check to Uncle Sam until April 15th of this coming year. So we have more cash on hand at the moment. The last of our current liabilities is dividends payable. And if I remember right, we've really accounted for this in great detail already. So let's go back to our step 3 numbers and see if I'm right. Oh, yep, there it is. I've accounted for all of dividends payable. I've looked at the whole T account. I've done everything I need to with it. I don't have to make any adjustments or calculations because not only have I made some notes like I have up here, I've actually done the T account already. So I can just make a note to myself that this is done. And that takes care of my current liabilities. So let's keep moving on. Let's take a look at bonds payable. Looks like we started at 4 million, we ended at 7 million. We're not in working capital anymore, so it's not going to have a direct relationship to my cash flow from operations. This is one of those scenarios where I want to just see, have I already adjusted for this, or maybe is there a cash effect I haven't looked at yet? So I'm going to do a T account again. Bonds payable, beginning at 4 million, ending at 7 million. And I'm going to look back through step 3 and see if there are any adjustments that I've already accounted for bonds payable. Let's see. Land and building, common stock, additional paid capital, available for sale, land and building. There's the dividends I just looked at, convertible bonds payable, common stock, additional paid capital, increase to investments. I don't see anything there. Available for sale securities, common stock retained earnings. There we go. An increase to bonds payable of $3 million. This is the issuance of a bond. And that was about the only thing I saw. We did see a convertible bond payable, but that was convertible bonds, and that's a separate line item. So I didn't worry about that for bonds payable. And if I look at the rest of these transactions, I don't see anything else for bonds payable, which is great because it's really easy to see that 4 million plus 3 million is my 7 million, and there's no additional cash here. I've already accounted for what I needed to. So there's no additional cash. Next is the premium and discount. Now, premiums and discounts do affect the cash we receive. They affect the cash we receive when we issue a bond. And we did issue one bond, but it didn't have a premium or discount, so I don't have to worry about it for that. But it also affects the relationship between the cash that we pay on a bond payable and the interest that we recognize on a bond payable. So this premium and discount is going to help with this conversion from interest expense into cash paid for interest. Let's take a look at the journal entry. It'll be easier to see that way. We debit interest expense for the period at $935,000. And then we would amortize away the premium or discount. So if we look at this account, it's got a credit balance because it's a positive number in a credit list. It goes from 656 to 642 with a $14,000 change. It's a drop, so that's a debit to this credit account. So that would be my premium amortization, would be that $14,000. So premium. And the credit would be to cash or perhaps interest payable for the balance. So 935, 14,000, 949. So if I think about this, I've got interest expense already in my income statement, but I want to turn it into cash flow. And I've made some of that adjustment by accounting for this interest payable. But I also need to account for the premium because that also helps me convert from interest expense to the cash I actually paid. So let's go ahead and put that premium in there. It looks like having that premium makes the cash higher. So I'm going to use my shortcut so I can figure out the sign of this. Let's see, interest expense is 935, negative because it's an expense. The cash paid is 949. So if I want to get from 935 to 949, I need a $14,000 adjustment, and I need it to be negative so that I show that more cash is going out. So let's put that into our cash flow from operations section, so that's where interest goes. We cleverly call this bond premium, and we want it to be a negative 14,000 to show that cash will be even lower than interest expense because we're amortizing away this bond premium. All right, there was a lot of discussion involved with figuring out the interest and how it works and why we do the premium the way we do it. Let's take a bit of a break here, and when we come back, we'll keep going with our long-term liabilities and then into equity as we finish up step 5. We'll see you then. Thanks.